Bob is an investor deciding between two promising companies to fund. He chooses one, and a year later he has an impressive exit. Bob pats himself on the back thinking, I knew that company was going to be successful. And this is hindsight bias. Hindsight bias is like looking in the rearview mirror and assuming you could have predicted the journey all along. It's like the I knew it all along phenomenon. In a startup scenario, once you know the outcome, it seems like the signs of success were pretty obvious. But were they really? Or are you just connecting the dots backwards? Money Arata. Now let's take a look at how hindsight bias plays out in the world of finance, of investments. Say that you invest in a stock that skyrockets. Then you tell yourself, I knew that was going to be a good bet. But the reality is that you didn't know. You just made a decision based on a series of educated guesses, and it paid off. This hindsight bias can make you overconfident in your decision-making abilities, making you perhaps taking bigger, potentially disastrous risks in the future. You might start believing that you have a magic touch, when in fact you just got lucky. Remember that the future is not as predictable as the past, at least not as it might make it seem. So be humble. Be aware. Don't let hindsight bias fool you into thinking that you can predict the market, because nobody can. So here's your key takeaway. Next time that you make a successful investment or any type of business decision, instead of claiming, I knew it, remind yourself of the uncertainties that you faced at the time of the decision. And this will keep your confidence in check, will help you to be making more prudent decisions in the future, and will prevent you from falling into costly traps. There is a method for this, so you don't get tricked by your brain, so this is what we're going to be exploring today. Attention, this is not financial advice. Please read the full disclaimer before proceeding. The hindsight bias is bad for all decisions in all areas in our lives. But it is even more harmful to your finances. You can protect yourself from falling into the trap of hindsight bias using a trading journal. But this is especially important in the realm of finance and investments, because if you don't do this, you have a bigger chance of losing money. What is a trading journal? A trading journal is a record where you meticulously document your thought process behind every investment decision. You write down why you decided to buy or to sell a particular stock, what the market conditions were, and also your initial predictions about the future performance. Now let's say that an investment does incredibly well. You might be tempted now to be thinking, wow, I knew it was going to take off. But wait, let's check your trading journal. What did you write when you made that decision? You'll often find out that your initial thoughts were filled with uncertainties and considerations of risk, making it clear that your successful outcome wasn't as inevitable, as clear as your hindsight bias might lead you to believe later. So the same applies when an investment does not go well. You might be quick to criticize your decision, believing that you should have seen that problems looming around, that failure coming. But again, the trading journal will provide you a reality check. It will help you to remember the context in which you made your decision, and it will keep you from unfairly judging your past self based on the information that you have in the present, right now. And by keeping a trading journal, you're creating a tangible way to challenge your hindsight bias. A trading journal will serve as a reality anchor, will remind you of the complexities, the uncertainties that are present at the time of each decision. And this, in turn, can help you to make more measured, better informed decisions in the future. So let's make it a practice. For every investment decision that you make, jot down your thoughts, your analysis, your predictions. It might seem like a little bit of extra work now, but it will save you from costly overconfidence in the future. Remember that in a world of finance, being realistic beats being overconfident at any day. Overconfidence is one of the worst traits for any investor, any trader. Lack of confidence is also bad because it can cause you to have paper hands. So you need to have a decent amount of confidence by having a system. And this is what we teach at Diamond Hands, which you can visit at arata.se/Diamond Hands. Active humility involves actively seeking out our mistakes, questioning our assumptions, and adjusting our beliefs based on new evidence. Humility is more than a state of mind, it is a practice. And active engagement with our own limitations, our fallibility. We might think of ourselves as humble, but without taking concrete steps to confront our biases and errors, we might just be fooling ourselves. This is where active humility comes into play. It is not about doubting ourselves, but rather about embracing the fact that we are constantly learning. That every decision that we make, every prediction that we hold, it is an opportunity to learn something new. Now, how does that apply to your financial journey? Well, keeping a trading journal is an act of active humility. It is a way of admitting that we don't know everything, that our predictions can be wrong. And when you look back at your journal, you're not just looking for the times when you were right, but also for the times when you were wrong. You're trying to learn from your mistakes, to understand why you made them and how you can avoid them in the future. Even if you're not a trader, you should take notes of your thoughts related to money in general. Because see, we all have different opinions and our own predictions about the state of the economy, the housing market, job trends, what the politicians will do this year, and so on. These thoughts come and go, often without us paying much attention to them. Yet, these opinions influence our financial decisions, right? From the big ones, like, is this the right moment to buy a house? Or to the small ones, like, should we go out to a restaurant to eat out? Now here's the problem. We rarely keep a concrete record of these predictions, and without a record, we're prone to the sneaky influence of hindsight bias. We forget about our wrong predictions, we remember the right ones, and we end up with an inflated sense of our predictive abilities. And here's where technology can come to your rescue. A digital note-taking app with a search function that will help you. Differently from traditional paper journals, the digital apps will allow you to record your thoughts and later do a quick search for keywords easily, no matter how many entries you have, how big it is. Now let's go through an example to explain this in detail. As you know, the content that we have in Arata Academy is very practical, it's to the point, so you can always use it to make better decisions, to have better concrete results. You need a system to actively detect your wrong predictions. Let's say it's January, and you notice that the restaurants are packed. So you predict, for example, well, the economy is very strong right now, but I do believe we are heading for a recession. And by June, these restaurants will be empty. So you write down that idea into your note-taking app. And then fast forward to June, you see the restaurants are still completely full. And a notification that you can set up will remind you this is the right moment to check your written thoughts. And instead of falling into the trap of hindsight bias and adjusting your memory to your January prediction, you can quickly search your digital notes. You see there, you see your January entry, you will be able to confront the fact that you had a wrong prediction. This practice will serve two important functions. Firstly, it will help you to recognize and accept that you made an incorrect prediction, which is a pretty humbling experience and will help you to keep your confidence in check. And secondly, it provides an opportunity to learn and improve your predictive skills. You can analyze what influenced you, what led you to believe to make that prediction in January, and why it didn't roll as expected. Using a digital note-taking app to record and later to review your economic predictions is a practical step toward maintaining a realistic view of your predictive abilities. It is about being actively humble, acknowledging that we might be wrong, striving to learn and discover our own mistakes. So let's make it a habit. When you have a thought, a prediction about the economy, you can write it down in a searchable format. That is a small step, but it is one that can have a profound impact on how you view your decision-making abilities and ultimately your financial success. And remember, it is okay to be wrong. What is important is to learn, to grow from these experiences. If you don't learn from your own errors, you make them over and over again until you lose it all. Most of us, by default, we fall into the trap of hindsight bias. We subconsciously twist our memories of past predictions to fit the actual outcomes, causing us to overestimate our predictive abilities. And this isn't a character flaw, it is just common human tendency. It is also a form of, unconscious arrogance, a distortion that makes us believe that we are better at forecasting the future than we really are. And you can resist this default mode. You should be conscious that you can make mistakes. And more than that, you have to embrace it. Practice now active humility. Make an effort to discover your mistakes and learn from your errors. This is a way to redefine your relationship with your future. And by recognizing the limits of your predictive abilities, you can start to see the distortion between what we can control and what we can't. See, we can't control the economy, the inflation rate, the price of Bitcoin or stocks or the housing market. We can always make educated guesses. But the future of these external factors is ultimately out of our hands. What we can control, however, are our personal choices, our actions. We can decide to maintain a healthy lifestyle, to save a portion of our income, to continue learning new skills. By actively searching for our own predictive errors, we grow more comfortable with this distinction. We become less anxious about the uncertainties of the future and more focused on the aspects of life that we can control. It is a liberating perspective, one that brings clarity, reduces stress, and enhances our decision-making. See, humility, it is not a sign of weakness, but of strength. It is the strength to accept our limitations, to learn from our mistakes, and to focus on what we can control. Humility is not a trait that you simply have. It is an action that you take. It is about accepting that we can be wrong, that our predictions can fail. And there is always more to learn. In the world of finance, active humility can save you from expensive mistakes, making you a lifelong learner and ultimately make more money. To have the diamond hands in your financial decisions, you need to have a mathematical model that will give you objective confidence. This is what you can learn right now by unlocking your access to a special class by visiting arata.se/diamond hands.